Year to date in the stock market, semiconductors have performed very strongly, with the vast majority up double digits across the board. And in today's episode, we are focusing on the most undervalued semiconductor right now, with some massive upside. Now, this is one that is trading right there towards its 52-week lows and even has a reasonable forward PE. We're going to do a deep dive on this company. We're going to understand why it is essentially hammered and why it looks to be incredibly undervalued. We're going to go through the top line revenue growth year on year, as well as their bottom line net income. We're going to analyze the health of the company, their total cash versus their total debt. And we also want to see not just what insiders are doing, but also what the institutions are doing in terms of buying and selling. And as always, we will take a look at their financial metrics. We want to see their free cash flow, their sales, ROIC, and a lot of other useful pointers to let us know where this company is moving. And what we also want to do is look at their latest investor presentation to see what they are guiding for the next few quarters, as well as historically how they've performed. And finally, we will take a look at this article. Now, it was released at the beginning of this month, but there are quite a few general points that we do want to discuss, not just the benefits, but also the risks that we do see with this semiconductor. And as always, we will run them through the valuation model, getting to our intrinsic value, getting to our acceptable buy price given our investor margin of safety, and also look to Wall Street to see the massive amount of upside they are projecting over the next 12 months. So let's start off with a quick historical analysis, and what we can see year to date, they have been very poor, negative 20.53%, one of the worst performing semiconductors. But when we do extend it to over the last 10 years, this has performed very strongly, up 1,398%. But we also want to point out it is down from the all-time highs that we have seen last summer at just under $200. Now, as we mentioned, it is trading right there towards its 52-week low. We in fact have two buys by analysts, Wall Street and Seeking Alpha, whilst we have quant analysts going against the grain with a sell rating. And we can also point out the market cap is fairly small at around 3.36 billion. So as there is a lot of scope for growth for this company if they do get things right moving forwards. So let's take a quick analysis of their central income statement. What we want to see year-on-year growth, minimum 3 to 7%. However, for this industry, the expectation may be a much larger increase. December 2014, 10 years ago, they reported 203 million on their top line. Latest annual accounts, we do see more than 5 times growth at 1.13 billion. And as always, it is quite nice to note this is a fast-growing company. When we look over the longer term, the growth is there. And we'll also look to see whether or not this is expected to continue over the next few years by looking at that investor presentation. Bottom line, well, how have they performed? Well, they reported a net loss in essentially 2014, negative 11 million. Latest annual accounts, 246 million. So positive to note, they have increased that bottom line, which was a negative 10 years ago. And when we look over the longer term, quite inconsistent year on year, but from 2019, where it was fairly low, we do see over the last 5 years increases year on year. So that is a positive sign. Last 5 years looking very healthy. Now, in terms of the health of the company, total cash versus total debt, 31 million is what they had on the balance sheet in 2014, 506 million from that latest annual report. And we do note their cash position over the longer term has been increasing. Now, factor in this 506 million, when we do look at their total debt numerically and directionally, what we can see is it has increased from around 14.5 million to 75.9. So yes, we do in fact see their total debt over the longer term has increased, but we also note their cash is a lot larger than their total debt position, so it wouldn't even take them one day to pay off all of their debt net of cash on hand. A very strong balance sheet and something we will look at when we look at those metrics. Now, we also want to look at some of their underlying metrics, and first one is their growth grade. Now, they get a B+. Why is it a B+ given? Well, a few metrics we can look towards. Year-on-year growth on the top line, 22.89%, significantly better than the sector median of 3.66. And even though the forward revenue growth has dropped from 22 to 10, we still note it is much better than the sector median. The other thing I'd quite like to analyze is their earnings per share forward over the next 3 to 5 years. they are expecting the EPS to increase 16.77, whilst others are having around 13.84 baked into their expectations. So lots of positives to note. Again, if you do want to take, you can see on screen the other ones, but we did just want to highlight a few key. Then we move on to the profitability, where they get a very strong rating here, A-. Gross profit margin does come slightly lower than the sector median, 43 versus 48.5. When we look at the bottom line though, however, much better, which does mean they are keeping those operating expenses low, 22% on the net income, whereas again, sector median low single digit at 2.73. So whilst we note their growth is okay at that around that B level, we see the profitability at an A- looking a lot better. And what I think is also important to analyze with this semiconductor, which we typically don't look at, is also the valuation grade, which we see as a B. Now, when we look at the P on a non-GAAP basis, we do see it significantly lower than the sector median on both a trailing 12 months, so a TTM basis, as well as on a forward basis as well. So it is looking very positive, and for those that want to look at it on a GAAP basis, again, it is still much lower than what we can see as the sector around the 28 level. So valuation looks good, profitability looks good, growth also looks good as well. So all signs are looking like this is a company that could be one that we should take a further analysis, and that is what we are doing in today's episode. Now, we can compare it to some others in the essential semiconductor industry with a market cap around that 3.5. We have Solar Edge, Form Factor, and a few others. Now, over the last year, as we mentioned at the beginning of the episode, very poor performance. They are down 12.67%. In fact, one of the worst performing in the industry. When we expand to the last 5 years, we actually note they are the second best. So when you do start to zoom out, we can see over the longer term, they have had some very strong returns. When we extend it again over the last 10 years, even with over a 1,000% total return, we do still see them the second best, with CMT coming in at 2,600. Now, any investment from any shareholder that you ask, if you were to get over 1,000% return over a 10-year period, they would bite your hands off and they would take that immediately. What is very key to understand, just because a company has performed so strongly over the last 10 years or even over the last 3-5 years, it doesn't necessarily mean that it will happen again. But overall, very strong performance on a historic basis. Now, insider ownership, 1.43%. We see 17.8 million worth of sales over the last 12 months, with a very small amount, a trivial amount, in fact, of buys over the same period. However, you would have to go back to around Q4 for the first instance of selling. We do note a small buy in Q1. We can have a quick look at these buys and sells, who they were from. So we do note, in fact, Douglas Lawson, the E-Vice President, did buy around 500 shares on the 23rd of February, around $111. So right now, as we can see, the share price is lower than what he purchased, and it was for around $55,000. As always, in fact, we do say a insider buy is a bullish signal, but you could argue the trivial amount does mean it doesn't make as much of an impact to your own investment thesis. And then we can see selling by another director. Again, as we mentioned, you'd have to go back to Q4 of 2023. So take that, use it if you want in your own investment thesis, but as always, do your own due diligence. Institutional ownership, well, nearly at that 90% level. Yes, we see insider, or in fact institutional selling at 729 million over the last 12 months, but we see a lot more buying, 2.53 billion, and in fact in the more recent quarters, Q4 of 23 and Q1 of 2024, more buying than selling by these institutions. Overall, more buying by institutions, not just over the last 12 months, but as we can clearly see in the more recent period. But again, it is important to understand, always do your own due diligence. Don't just copy what institutions do or even what insiders do. Now, before we look at their metrics, we can have a very quick look at their latest investor presentation. Now, this was a few months ago, so we are waiting over the next few weeks to see their updated Q1 earnings for 2024. So let's have a very quick look. Now, for those that don't know, they are a global leader in technology, not just development, but also manufacturing of these ion implant systems and services. Now, these go into electric vehicles, as we will shortly discuss when looking at some of the risks with this company. And what we like to do is look at their Q4 results. So this was their latest results, and Q1 is what the market is now expecting. Now, their revenue over the last quarter, why it's important to understand, 310 million as we can see for Q4. What they are expecting in the next quarter is a lower amount, 242. One of the reasons why we did see the share price drop over the last few months. What we also know, even though the gross margin over the last quarter was 44.4, we can see their outlook of 43.5 is in line with the full year results that they had for 2023. Also to note, their earnings per share is expected to be lowered in Q1 than what they received in Q4 of 2023. So we do know that there are some essential measurements that are reducing, and this will be important not just in the financial metric analysis, but also when we do come and look at our own valuation and margin of safety, because we may want to implement a larger MOS level than maybe we normally do for other companies. Now, just to let you know, we have released our latest free weekly article. We have a lot of articles that you can gain instant access to, and you don't need to pay a penny. One of them that I would suggest is how we look at these companies, how we find undervalued stocks. A lot of people in the community ask, what websites do you use? And this is all explained in this article. And we have others looking at undervalued dividend stocks and just general finance articles. As always, click on the pinned comment below and you can take a look and get instant access. Now, with a company, we always want to be investing in those that have free cash flow growth year on year. We do note a lot of inconsistencies over the longer term, but we can see from 2020 it has been on more of an increasing upward trend. We do note the drop into 2023, although 2024 they are expecting a very large increase to that free cash flow, which is a positive sign. We then look at sales growth. As we mentioned, we really want to see for a semiconductor more than 3 to 7% as the general market, or in fact industry, does trade at a relatively high premium. We can in fact see over the last 4 years double-digit growth to their top line, so that is looking very strong, although we can note 2 of the last 10 years double-digit negative growth. Again, you can argue the cyclicality of this industry, but overall just another format to what we looked at earlier. Shares outstanding, now 2 things to note. Firstly, it is very minimal at 27.9 in the starting point of 2014 and a very small increase over the longer term. Nonetheless, you would have been diluted as a shareholder, but as I always say, in instances like this, like for ACLX, realistically you wouldn't care given that the share price is up over 1000% during the same period. Now, when we look at the ROIC, essentially showing us that management are able to effectively allocate their capital, as it is for the large part above 10%. Last 3 years, very strong, right there at the high 20s, giving us a good sign, making this very attractive for investors as well as those potential investors. Operating margin, well, we want to see a minimum here of around 16%. Over the last 3 years, they have done this, and on top of that, I would make a note of operational efficiency, as we can see the increases over the longer term. In terms of the free cash flow margin, a little bit more inconsistent, but I would say over the long period, it is looking fairly healthy. 22-23% in 21-22. We do note a drop down to 12%, but realistically, as long as it is around that 7% as a bare minimum, then that is a fairly positive sign. In terms of the net debt to EBITDA, so the earnings before the interest, tax, depreciation, amortization, we run through this earlier, but this shows us essentially the number of years it would take the company to pay off their debt net of cash on hand. Every single year over the last 10 years, bar 2014, it wouldn't even take them 1 day. The same is still expected in FY24 as well. So looking very healthy in terms of a balance sheet perspective. So now let's take a look at this company. Now, we did mention at the beginning of the episode, we want to look at this article. It does raise some interesting points. And in fact, even though it was mentioned or in fact discussed on April, we can see at that point it was also down significantly, 45% from their 52-week highs. So let's take a look at some of the points, and we will start off with the very first paragraph. And it does start off talking about what we essentially discussed right at the beginning of the episode when we looked at the S&P. The overall market does seem to be on fire in relation to AI semiconductors. However, similar to ACLX, which is a semiconductor which is closely related to electric vehicles, auto and industrial chips, they are in a bit of a downturn, as we have noticed with that share price that has come down year to date significantly. Now, this company, like others, also had some strong growth in 2022 and early 2023 due to the EV market being very strong. However, now the EV market has started to slow down, as well as China's poor economy. And now what we are facing is a downturn in chip stocks like ACLS in this market. So let's talk about one of the key players, as we mentioned, Ion Implant Equipment's ACLX, and talk about where they do go from now, moving forwards 2024 as well as 2025. Now, one thing that we did discuss as well is the fact that their valuation in terms of a forward P is around 15 times earnings. So it does look like it could be a very strong opportunity. They have 500 million in cash on their balance sheet, as we discussed, and very minimal debt. So there are a lot of positives with this company. However, as we did say, the electric vehicles have started to plummet, as well as China's poor economy. And on top of that, higher interest rates is making it more and more difficult for these big ticket items to be bought by the bigger companies that use essentially these ion implant equipment chips for EVs. So in terms of some bullish reasons and some bearish reasons, as always, it is good to look at both sides of the argument. We can see just on a quarter-by-quarter basis, the increase in their revenue was only 6.2% for the quarter. Why we say only 6.2%? Due to the fact that, as we looked at earlier, their full-year growth rate was sitting at around 23%, and they've also guided down their top line by around 20%. As we took a look at Q1 of 2024, they are expecting that revenue as well as their earnings per share to be lower. Now, in terms of looking forwards, they did have a guidance of 1.3 billion on their revenue in 2025. Remember from the previous year of around 1.1 billion. And also we can see an expanding margin, which is always positive to see. Not just growth on top line revenue, but also when margins increase, that is a double positive for investors. And that would sit around the 15% growth mark, where we did say for the previous year sitting around 23%. And the management, as always, we wouldn't expect anything less, are remaining fairly positive with growth expected into 2025 and beyond. So let's take a look at some of the risks to this story, as we can see being mentioned here, and whether or not there are anything that we should be worried about. The first one is maintaining that top line growth. As we can see, 16.8% or even double digits is a little bit of a worry, especially when they have downgraded their revenue for the next quarter, as we saw, by around 20%. Now, they are somewhat dependent on the electric vehicle market, so if it does continue to disappoint, then it will affect these essential chips which are going into these cars. And one thing that maybe we haven't touched upon is that their revenue does come from China, or a significant amount. They expect full year 2024 that half of their revenue will come from China. And the risk associated with this is, for example, if they deliver their own tools and then they move away from ACLS, and therefore this could take away a large chunk of their top line. Now, as investors, you will need to come to your own conclusion whether or not you do believe that the risks outweigh the essential benefits, or whether the benefits outweigh the risk. But in conclusion, they do believe from this article alone that the positives do outweigh the negatives. So let's jump into the valuation. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button, and don't forget to drop us your thoughts in the comments below as we go along. So the first model that we are taking a look at today is multiples valuation model. We have companies in a similar sector, and we can see here their P multiples, the average, then we multiply by the EPS of ACLX to get an intrinsic value of $232, as we can see significantly undervalued with the current market price of $103. There were many others that we could have selected within this model, but if you do take a look yourself, a lot of semiconductors do have significantly higher Ps right now, something just to bear in mind. The second model we are using is the discounted cash flow model, where we have the free cash flow year on year. Average growth rate, as we can see, skewed quite a lot given the fact that it has gone from negative to positive. But overall, forward looking, we are going with a 10% rate, which we do believe to be on the more conservative side. When we get the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. And we can see here another undervaluation signal with an intrinsic value of $146. So as always, the intrinsic value is just the average of these two models, and it does come in today's episode at $189. Bear in mind, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those in your watch list by clicking on the pinned comment below. We always start off with a margin of safety of 10% if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Then what we keep doing is we go till it's near the current price. So right now, if you believe that, a 10% MOS means a buy up to 170, and at 20% around 151. When we move to 30%, we can see 133, at 40% 113, and then at 45%, pretty much right there towards the current price. So in today's episode for ACLX, we do have an MOS level on the estimates and judgments of 45%, but as always, it really will depend on how you see the risk for this company, whether or not you believe 45% is enough, or maybe you think that is more than plenty and it may be a good time to consider for the portfolio. In terms of Wall Street and their price over the next 12 months, well, they see this as a massive strong buy at a minimum consideration for your own portfolio with a price target of $165. And as we can see, that's 60% upside. Do remember though, there is also the risk, as we saw, that China is expected to take up half of their revenue in FY24. But if you can mitigate that risk with that margin of safety, depending on what you believe is comfortable. As always though, do let us know your thoughts in the comments below. Is this a semiconductor maybe you've got your eye on, maybe you've been buying, or maybe it's just on the watch list? And if you enjoyed the episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.